Are diversification and hedging the same? Diversification and hedging are two strategies investors use to manage risk. While they may sound similar, they have distinct purposes and methods. In this video, we'll break down the differences between diversification and hedging, and we'll talk about some common hedging examples as well. The best known analogy for diversification is don't put all your eggs in one basket. This means there's more risk of losing one egg, but less risk of losing all of them. By spreading your money across different assets, you are spreading your risks and returns across a range of products. If one stock or one sector goes down, you won't lose a large portion of your investment because it's unlikely that all different sectors will decline simultaneously under normal market conditions. The main goal of diversification is to help investors avoid disastrous outcomes when markets are operating normally. I have emphasized the normal market condition twice now because it's important to know that diversification provides downside protection based on the assumption of normal market conditions. There are two types of risk to consider: systematic risk and unsystematic risk. Systematic risk, also known as market risk, is tied to the broader market. It's the uncertainty that the market faces due to factors like interest rate changes, recessions, financial crises, wars, natural disasters, global pandemics, or other black swan events. In finance, the systematic risk of a security or portfolio compared to the market is expressed as beta. The S&P 500 has a beta of 1. A stock with a beta higher than 1 is more volatile than the S&P 500, while a beta lower than 1 indicates less volatility. Unsystematic risk is specific to a company or industry and can be affected by its business conditions, financial health. The total risk for investments is the sum of systematic risks and unsystematic risk. Now, what do these risks have to do with diversification? Systematic risk is unpredictable and impossible to avoid altogether. Diversification cannot mitigate this risk, meaning it's not diversifiable. In severe market turmoil, the strategically chosen baskets for your eggs are all broken, so your eggs cannot be saved either. Unsystematic risk, this risk, on the other hand, can be reduced through diversification. Imagine if you're a US investor holding 100% of your investments in an S&P 500 index fund. The annual expected return for the S&P 500 is 9.93%, and its risk, expressed as standard deviation, is 16.21%. By holding 100% in this fund, this is the return and risk profile you will get. To diversify further geographically, you decide to invest 80% in the S&P 500 and 20% in the emerging market, which is MSCI Emerging Market Index Fund. The expected return for the Emerging Market Index Fund is 18.2% with a standard deviation of 33.11%. The covariance between the S&P 500 and the Emerging Markets Index is 0.5%. You may ask, what is covariance? Covariance measures how two assets move together. For instance, if stock A's return increases, whenever stock B's return increases, they have a positive covariance. Covariance is needed to calculate the risk of two assets portfolio. The expected return is a weighted average of the expected returns of each asset. In this case, the expected return of a portfolio consists of two index funds will be 11.58%. The risk or standard deviation of the portfolio with two assets is calculated using the formula. Adding the riskier emerging market index fund actually reduces the overall portfolio risk while improving the expected return. The reduction in risk comes from the fact that not all assets move together. The portfolio risk can be more easily understood by replacing covariance with the correlation coefficient, which ranges from -1 to 1 and shows the degrees to which two assets move together. When the returns of two assets are perfectly positively correlated, they move together 100% of the time. The portfolio standard deviation is a weighted average of the standard deviation of the two assets. Consequently, the more weight given to the riskier asset, typically with a high return, the riskier and more expected return the portfolio would be. This scenario does not showcase the benefits of diversification. When two assets have low positive correlation, In our example, the covariance is 0.005, indicating a low positive correlation. This means the assets' returns are not strongly correlated, and diversification can help reduce the overall portfolio risk. When the returns of the two assets are uncorrelated, the movement of one asset provides no information about the movement of the other. In this case, the portfolio risk is further reduced without affecting the portfolio return. When the returns of two assets are perfectly negatively correlated, they move in opposite directions 100% of the time. In theory, this can reduce the portfolio risk to zero. This principle is related to hedging, where the goal is to offset potential losses in one asset with gains in another. We'll elaborate in a bit. In reality, finding negatively correlated assets is difficult. Most assets have high positive correlations, so the challenge lies in finding assets with a correlation much lower than 1 to achieve effective diversification. The hypothetical example that we just discussed earlier also reviews a drawback of building a diversified portfolio. Since the portfolio's expected return is a weighted average of the expected return on each asset, the return on a diversified portfolio can never exceed that of the top performing investment, but will always be higher than the worst performing investment. When building a diversified portfolio, a lot of people have asked how many assets are sufficient to build a diversified portfolio. In 1977, Edwin and Martin considered a population of 3,290 securities available for possible inclusion in a portfolio and see how risk is reduced over all possible randomly chosen asset portfolios. Adding more randomly picked assets into a portfolio can reduce the overall risk, but effect diminishes after 30 assets. The portfolio risk of 30 assets is close to a portfolio that consists of 1,000 assets. Even 4 stocks provide most of the risk reduction compared with 1 stock. While diversification involves investing in uncorrelated assets or low correlated assets to spread risk, while hedging involves investing in negatively correlated assets to offset risk. So technically, hedging is a form of diversification. A perfect hedge will eliminate all risks in a position or portfolio by being 100% inversely correlated to the vulnerable asset. This is purely hypothetical, but even a perfect hedge comes at a cost, reducing its net gain. There are some common hedging strategies such as insurance. Say you own a home in a flood-prone area. You can protect it from the risk of flooding. Hedge it by taking out flood insurance. Insurance negatively correlates with your assets, the home. If your home incurs flood damage, loses value, the insurance policy will provide a payout, positive return, when they lose value. They will give you a positive return. If your home does not experience flooding, remains value, you receive no payout. The possibility of a significant loss is drastically reduced with insurance. However, insurance generates a negative average return over time, with the monthly premium adding up even during the periods without losses. The trade-off is the cost of the insurance premiums, which reduces the overall return on your asset. Buying put options is another effective hedging strategy. A put option gives the holder the right, but not the obligation, to sell the underlying security at a predetermined price, the strike price, on or before it expires. For example, you bought 100 shares of ABC shares at $10 per share and are concerned that the price might drop. You pay a $1 per share or $100 in total premium to buy a put option with a strike price of $9, expiring in 1 year. If the stock trends upwards, when ABC trades above $10 per share during the year, you won't exercise the option. Your loss is limited to the $100 premium paid for the put option. In an extreme case where ABC's price drops to zero, you exercise the option and sell your shares for $9 each. Your total loss is $200. Without the option, you would have lost your entire $1,000 investment. The put option significantly limits your downside risk. In general, the higher the strike price, the more expensive the put option will be, but it will also offer more price protection. This proves again that hedging isn't free. Currency hedging is a common strategy used by banks, corporations, and fund managers to manage the risk of fluctuations in exchange rates. This form of hedging is essentially insurance for international investments, ensuring that earnings in a foreign currency are protected from adverse currency movements. They normally buy a forward contract, which locks in the exchange rate for a future transaction. This means that regardless of how the exchange rate fluctuates, the agreed upon rate is used when the transaction occurs. Many investors buy gold and other commodities to hedge against currency and inflation risks. Gold in particular has historically served as a safe haven during periods of market volatility and economic downturns. According to a study by Bloomberg, gold in Aussie dollars provided attractive returns during the most severe pullbacks of the ASX 300. This negative correlation with the ASX equity market over the past 30 years demonstrates gold's effectiveness as a hedge. Gold is also considered a good hedge against inflation. When inflation rises, the value of currency typically falls, but gold tends to retain its value or even increase in value, preserving purchasing power. And there you have it. We've explored the differences between diversification and hedging and how various strategies like insurance, put options, currency hedging, and gold can help manage and reduce risk in your investment portfolio. From the correlation perspective, hedging can be considered a specialized form of diversification. Both strategies aim to manage and reduce risk, but they do so in different ways. It's essential to balance these strategies based on your financial goals, risk tolerance, and investment horizon. My name is Irene. I'll see you next week. Bye.